Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, March 15th, 2023. Starting with the economic release spotlight, I just wanted to quickly highlight the simple fact that America's inflation problem is actually getting worse. So, taking it to the chart here, where we show our measures of underlying inflation across median CPI, trim mean CPI, median PCE, trim mean PCE, and then core PCE, which is obviously the Fed's preferred inflation gauge. So starting with the median CPI, we get these statistics around noon on the day that CPI was released from the Cleveland Fed, and we are seeing a reacceleration. So it's the second consecutive month of accelerating median CPI inflation on a 3-month annualized basis. We look at it this way to put ourselves in the seats of policymakers who some of them may be wanting an easy way out from the Fed tightening initiative, and ultimately they're not getting that from the data. So accelerating to 7.5%. That's the highest print we've seen since October. Probably more worrisome, not necessarily to me, but I think to some of the members of the FOMC, perhaps, and certainly policymakers abroad or in DC, is the fact that median CPI, which is the median price change across all of those, let's say around 400 categories within the consumer price index, it's actually accelerating for the third consecutive month to a cycle high of 7.2% on a year-over-year rate of change basis. That's the red line here. Trim mean PCI, which is effectively the same process, but cutting off the upper eighth percentile and the lower eighth percentile from the time series, from the baskets in terms of the change. We're getting to 6.2% on a 3-month annualized basis. These numbers are obviously well north of anything that looks like sustainable 2% core PC inflation. They're obviously well north of the pre-COVID trends as well. And in our opinion, give Jay Powell and the rest of the FOMC plenty of legitimate excuse to continue on with their tightening initiative. If anything, you ask me, I think the steps that they took to shore up confidence in the banking sector, and of course, there's probably going to be more steps if we take another lurch down in markets. The steps they're taking, in my opinion, allows the Fed to compartmentalize financial stability, that mandate, and really refocus its efforts on its monetary policy stability mandate, on its price stability mandate, and ultimately they are nowhere near achieving their objectives if you look at inflation, nor if you look at the tightness in the labor market, the structural shifts in the labor market that continue to contribute to sticky employment growth and obviously structurally elevated wage growth relative to previous trends and business cycles. One thing that's given me confidence that the Fed may, in fact, continue hiking interest rates next Wednesday is the fact that the U.S. economy seems to be doing just fine if you look at the retail sales data. We've been very out on the far right end of that spectrum between recession now, which is the Wall Street consensus, and the 42 macro consensus since last July has been no, the economy's booming. I would argue it's no longer booming anymore, but we certainly got a booming data point out of the retail sales print this morning for the month of February. So we saw core retail sales accelerate from 5.8% on a 3-month annualized basis to 10.1% on a 3-month annualized basis. 10 with 10 of these fingers, 10 fingers. This is an economy that is nowhere near, in our opinion, a recession. And obviously, all bets are off if we have a large-scale banking panic, but that's not our baseline view. And so, ultimately, we do believe this move that we're seeing in 42 macro net liquidity that's got the crypto community very excited. Expecting Bitcoin and other digital assets to start pumping to the moon because we've seen this $300 billion-ish increase in net liquidity since last Monday. I would argue this is a good opportunity to be selling into in terms of your Bitcoin exposure, in terms of your digital asset exposure, because ultimately what we do think is likely to happen over the medium term is that this move we've seen higher in net 42 macro net liquidity is going to run out of steam. We only have $208 billion in the Treasury General account balance, and at the current pace, we could be there by the end of next month. As it relates to, in fact, I would argue we could be there by the end of this month at the current pace. If you look at the last few days of decline in the TGA, and then obviously if we do start to see any sort of broader banking panic where depositors at regional banks, wholesale depositors, people, companies, and businesses, tend to be not FDIC insured. Which, by the way, the FDIC did not insure all deposits; they only insured the deposits of the banks that went bust. If we start to see some of that banking panic in terms of taking deposits out of smaller banks and medium-sized banks and putting them into larger banks and or putting them into money market funds, you're not going to see a favorable reverse repo facility dynamics. So 42 macro net liquidity could be at a very asymmetric high. We reached this asymmetric high in August. We reached this asymmetric high in early December, and now we're back at this asymmetric high here in mid-March. So I just want to make sure that everyone's aware of that, and they're actually just being prudent. This is not the time to be taking a whole lot of risk in financial markets. There is still a phase two credit cycle downturn ahead of us to price in. Phase two credit cycle is when unemployment rate starts rising, consumers and companies and consumers and companies start to go bankrupt, and ultimately it becomes very hard for buyers of assets to kind of meet and find a price for the sellers of assets, and ultimately you start to see that process get very hairy in financial markets as the suppliers of liquidity demand ex ante positive returns, i.e. lower valuations from the demanders of liquidity. And we just have not seen that process yet play out in the credit markets, nor have we seen that process play out as it relates to equity sector and style factor dispersion. Check our most recent macro scouting reports on that. Transitioning to my Longbow dashboard, which is the home of the best trading ranges in the world, in my opinion, certainly the best application software I've seen to navigate, to help you navigate these tactical pivots in asset markets. The one thing that's flagging on my global macro screen this morning is crude oil. Crude oil is oversold, and it's now starting to bottom and base at the lower boundary of the Longbow trading range. Recall that crude oil going down is obviously a deflation signal, alongside obviously the puke we've seen across interest rates across the entire curve in recent days and weeks. And so, what do we know from our 42 macro weather model is that we are in a deflation regime. It's a very high conviction deflation regime once you incorporate the implied deltas on growth and inflation that are implied by consensus estimates. And so, clearly, crude oil is one of those factors, is those macro factors that's not going to work. However, if we start to see any sort of reprieve on the on this banking side, on the banking panic front, then it's very likely that crude oil is going to bounce over the next few days and weeks. It doesn't mean it's going to undo its bearish momentum on a short and medium term basis. But again, if you're short crude oil, you're short commodities, you're expecting broad-based deflationary panic here, this would be a good spot to be lightening up on that position. Or if you're a tactical trader, this would be a good spot to be up, introducing, kind of some convexity on the long side. And then lastly, energy XLE is also deeply oversold here. Kind of looks like a chart of regional banks as well. So clearly getting some deflationary signals out of markets. Our model's been in deflation since going back to August in terms from a bottom-up macro regime perspective. We have not seen deflation yet from a top-down market regime perspective. And so ultimately, if we do start to see deflation from a top-down market regime perspective, I think that could be the market pulling forward the phase two credit cycle downturn, which we thought would ultimately commence in the third quarter of this year into, let's call it, the late first quarter, second quarter of 2023. So this is not the time, in my opinion, to be betting on Bitcoin mooning and the Fed's about to supply the market with liquidity. Fed ambulance sirens, which is something I taught global Wall Street community a year or two ago. This is not Fed ambulance sirens time. This is hunker down and survive to the actual next bull market time. So with that, Darius Dale presenting our macro minute for Wednesday, March 15, 2023. Best of luck out there. And if you need help interpreting all this stuff, I know a lot's coming at you really quickly. We have a bunch of sophisticated tools to help investors, buy side, top $1 trillion asset managers, all the way down to mom and pop retail investors. We help them manage the risk through these very trying times with our litany of quantitative tools. So looking forward to helping you risk manage yourself to the next bull market. Cheers.